Welcome to the Dividend Talk podcast, episode 51, the Wheel Options Trading Strategy. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with Phil Ziegler. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. So those of you who have been listening, we have a new name in the intro. I'm joined here with Phil Ziegler instead of European DJI, who's on holidays. Phil, willkommen zum Dividend-Gespräch.
Vielen Dank, EMF. Es ist eine Freude, hier sein zu können.
I got a little bit of that, but my German, it is not as fluent as I'd like. But hey, welcome to the show. I'm glad to have you here. I know European DJI is off enjoying the sun, having some wine and maybe sangria. So it's great to have you as a co-host.
Yeah, thanks a lot. I'm really excited to be here. I think we have a nice topic today and can't wait to discuss the details.
Yeah, we're going to talk a little bit about options trading. I know we've discussed a lot offline about this. We kind of chat together on this, so I'm excited to talk about this and a little bit about what we do. But before that, you know the usual layout of the show, so we're going to go through the same kind of layout. So we're going to talk a little bit about the news of the week. So is there anything that has propped up on your side?
Yeah, definitely. So I have, from the political side, apparently the European Union finally came to a conclusion with the topic of country-by-country reporting for corporate taxation within Europe. And to be honest, I don't expect that it will change a lot in a first step, but I think it will bring a lot of transparency what's happening with corporate taxation and where big corporates pay taxes or not.
Yeah. I feel like this is a stepping stone onto a more generic, maybe level playing field. But as I mentioned on this show before, one of Ireland's competitive advantages is this low tax rate. I can't remember. I believe I saw something during the week that America have a minimum tax rate. I've been so busy, I didn't follow up on it. But if this field is leveled out, it might affect multinationals coming to Ireland. So I don't know how I feel about it from an Irish point of view, but from a European point of view, it certainly makes sense to have everybody playing on the same field. So I believe you have something a little bit more on the tech side on the news as well.
Yes, that's right. So I saw also an article about a company called Boom Supersonic, and I've never heard of them, but apparently they want to enter the space of supersonic airplanes again. And I think it's around 18 years that the last Concorde was flying. And seeing all those promotional videos from them, I mean, it sounds super fancy indeed. London, New York City under 4 hours. Wow. I mean, that's impressive if that works again. And I mean, it's also, let's see if such a small player can fight against Airbus and Boeing. But okay, that's a different topic.
Hey, they might have a chance against Boeing the way they're going at the moment. But I'm starting to feel a little bit old. I remember hearing about Concordes and going from Europe to Australia in 10 hours or so, or even less. I would love to see these back. It would be amazing from a technical point of view. Just to see these in action would be quite something. Why would they discontinue it in the first place? There must have been safety issues, was there?
Yeah, I think it was a little bit both. I mean, there was, of course, this one big accident, I think, at the Paris airport where Concorde was crashing into some houses nearby. But later on, what I read is that apparently they were pretty expensive to maintain. Yeah. And in the end, it was always kind of a premium airplane, only business class potentially. I'm not familiar with all the details, but I think it was never really economical thing.
Yeah. It would be awesome to see them back and hopefully fly on one at some point. So I have something a little bit light. I read a book. I don't know if you've read this book before, but it's called Bad Blood. It's about a startup over in Silicon Valley called Thanos, and they were selling medical devices to lots of different places, including Walgreens, and they were not quite honest in their approach. I won't ruin it in case anyone hasn't read the book. I definitely recommend reading the book. But it was funny, it just popped up on my Yahoo Finance that the CEO of this company is now has to go to court, and they're trying to exclude certain evidence. So for anyone that has read the book, this will make sense. If you haven't, go read the book. I couldn't leave it down. I think I read it in like 2 days straight. It's a brilliant book. Definitely worth checking out.
And that's based on a true story?
Yeah, true story. Yeah,
Ooh.
true story. Yeah,
Oh.
yeah. I don't know if you can see my bookshelf behind me, but I have it there.
Yeah.
I'd ship it to you if I could. But it's definitely worth reading. It was actually European DJI had it on. I think he did a blog post before on 5 books or 6 books, and this was one of them. And I got it from there.
Yeah, to be honest, the stories where there's some truth behind. I mean, they're way more scary than all the other thriller or horror books.
Yeah,
because it's really happening, or it happened before.
I mean, Silicon Valley is painted as this. I don't know. Before I see this illustrious place, and you can do no wrong, and everybody is honest and nice. But this paints a slightly different picture, and hours that people work, and all sorts of issues. So it's definitely worth reading. The second piece of news actually is around Walgreens. I know I've mentioned this before, but they've completed their divestiture to Alliance Healthcare for $6.5 billion. So that has completed this week, which is good news for investors. Still quite happy with Walgreens. So this is just money in the bank. I know they still retain some ownership of the company as well. So it's nice to see it progressing anyway. Cool. So what we might do is we might move on to the main topic. I know we said we'll talk a little bit about the wheel strategy, but we might just give a little brief explanation around some of the basics of options and option trading, just for some of our listeners that may be new to this. So do you want to maybe talk a little bit about maybe the main components and some of the common phrases that we might use throughout the show?
Okay, let's go ahead. So an option in itself is a contract. So it is a financial derivative. It is connected to a stock, but in itself, an option is a contract. And there are indeed 2 flavors, and many of the listeners most likely heard them, especially nowadays with all the short squeeze topics that are in the media. Yeah. So basically, there are 2 options. The one is a put option, and the other one is a call option. And with a call option, you get the right to buy a stock, and with a put option, you get the right to sell a stock.
Okay. So you have the right to sell. So if you're a buyer of a call option, you have the right. But what if you're the seller of a call option?
Yeah, with that, you actually have the obligation to sell a stock.
Okay. So you have the obligation then to sell that stock at a predetermined price, which is called a strike price. And you have to sell that regardless of how far the stock has gone up. Okay.
Yes, exactly.
And it's the same then on the put option side. If you're a seller of a put, you have the obligation to buy that asset at a predetermined strike price. Even if that stock went to, I don't know, 0, you still have to buy it at the price that you bought the contract at. Okay, so I've spoke a little bit about strike price. So what is that strike price there?
Yeah, so an option basically has actually 2 elements. Or 3 elements to be precise. First, it of course defines about which stock do we talk. The second one is indeed the strike price. That's a target price, so to say. A contract will say you will have the right to buy a stock at $100, for example. That's the strike price. And that's completely independent of the current market price. Okay.
And there's different terms within that strike price. So you might have heard out of the money, at the money, and in the money. You just maybe explain what those 3 terms mean.
Yeah, that's basically just a fancy words to say, okay, is this strike price now higher than the current stock price or not? I mean, if an option's, for example, in the money, then it says that the strike price is higher, so the stock price is lower than the strike price. If it's out the money, then the current stock price is higher, so it's out of the contract.
Okay, and like all contracts, then we have different expiration dates. We have weeklies, monthlies, and sometimes even longer ones called leaps. So we'll be focusing mainly on weeklies and monthlies on our strategy, but you can buy them for a year or maybe 2 years in advance as well. So that's the amount of time that you can hold that contract, but that position can be closed early. And I think that's important to know as well, that it's not guaranteed to last. So the opposite person on the other side of the contract can decide to close that early if and when they decide it is the right time to do so. And I suppose there's two other aspects we should mention, and one is volatility, and then the other is the Greeks, which everyone knows. So maybe if you just give a brief overview of what volatility is and what it means.
Yeah, so there are indeed two volatility aspects that we can talk about. The first one is the historical volatility, and that really goes about, how volatile was a stock in the last time. I mean, of course, there are then different volatility numbers. Is it about 30 days only, 52 weeks? I mean, always need to check which volatility is mentioned. And the second one is the implied volatility, and that's actually the likelihood of a change in a company's price looking forward. So it also considers a little bit, what is the stock market actually thinking should happen or could happen with the price. It's actually very interesting that this is really a measure to say what's, the intelligence of the community, what do they expect to happen with the company.
Yeah, and I suppose it's a little bit associated to the risk around the stock, because the higher the implied volatility, in theory, the more risk you may be taking on. And that's important to note, because sometimes it can be easy to follow these meme stocks like GameStop and AMC that have high volatility, but there's risk there on that. Okay, and then the Greeks, if you just want to maybe list them, but we only are going to talk about 2 or 3 of them. So delta, I suppose, is going to be important from our point of view. And this is, I suppose, the rate of change in an option price. So this can vary between 0 and 1. Typically, we'll be looking at out of the money and maybe 0.3 delta. So that means that there's a 70% chance that this stock will be out of the money, and there'll be a 30% chance that will be in the money, get assigned. And that might make more sense as we talk through the wheel a little bit later on. But in theory, we want a low risk of being assigned. So we're looking for a high percentage that we will be out of the money. There is Gamma and Vega and Rho. I don't use them a whole lot in these. They are important to know. So I'd recommend checking them out. But Theta is another one that I think is really important. And that's the rate of change about the value of your portfolio with respect to the passage of time. So it is also referred to as the time decay of the portfolio. And this is important depending on the date that your expiration is. If you have a short expiration like weeklies, your theta decay could be a lot quicker than a longer one. So delta and theta are 2 that are important for our strategy. But then you've also got Gamma, Vega, and Rho that are certainly good to know in terms of options overall. So the first question I'd have for you is, are options risky? Because before I got into this, it was always a question that I had in my own mind. They always seemed so risky. What's your take on that?
Yeah, a good question. I mean, certainly they have their own type of risk, because it's suddenly, a time element that you introduce to the complete system. It's not only, about buying a stock and owning it. Somehow, a contract that says like, okay, you need to buy a stock in the future, or you need to sell a stock in the future. I mean, that automatically brings some risk in it or to it. But in itself, since an option is always tied to an underlying, that's also a word that you will hear very often. I mean, it's connected to a stock. I mean, the yeah, the big part of the risk actually comes from the stock. So let's assume indeed GameStop or AMC or a steady state medical company. I mean, there's a lot of business risk in there, so there will be also a lot of premiums, a lot of volatility. On the other hand, if you think about AT&T, for example, a company with a very steady cash flow, without big movements in the share price normally, you will not get a lot of premiums because there's no volatility.
Yeah.
So in my opinion, options do not bring an additional risk if you know what you do.
Yeah, it really depends on the strategy that you use and the reason why. And I suppose for the wheel strategy, I think the key component, well, for me, is to only choose stocks that I want to own long term. I know when we discussed this and we've got caught in a couple of trades when I began, I have Solo and Ride are two tickers that I got caught because I was chasing high IV, easy money. It doesn't work like that. So we've kind of refined back my strategy a little bit, but options can be risky. 100%. There's no doubt about that. It just depends on how you use them. A couple of terms to know: you have covered calls and puts and naked call and puts. And that can define how risky it is as well. So covered basically means you have the cash or enough shares in your account to cover your option. So you need to know that options require you to buy or sell in 100 shares. Typically, I know there's in the London Stock Exchange it's 1,000, but typically we'll be looking at 100 shares. So if you are selling a covered call, for example, or selling a call, if you were to get assigned and it was in the money, you would have to either hand over 100 shares or you would have to buy 100 shares at your price to give to somebody else. So it can be risky. It just depends on how you use them. So I know there's two ways that you use them. Do you want to talk about the first way that you use them for?
So the first way is actually now a way where I use the options only as a tool for my dividend portfolio. So let's assume, for example, Unilever. I mean, I'm always curious to get some Unilever shares at 45 euros. That's kind of a threshold where I feel comfortable buying more. But now the stock is, let's say, at 47. I mean, of course, I could place a buy order at 45, good till cancel, and let's see what's happening. But I mean, it could go down and then buy it at 45, or it goes up and I will never buy it. In that context, if I want to buy 100 shares, I could also sell a put option. So I will have the obligation to buy a share or a stock at 45, but I get paid for it. So I actually monetize my waiting a little bit in that perspective. And sometimes there are also some, esoterical comments or theories about you wait for the stock to come to your price level where you want to buy it. I mean, that's something you will hear. And
yeah. And do you have a particular expiration in mind for this type when you're using it for your dividend portfolio? Do you use longer term expirations or weekly or monthly?
That depends, because with options you will always see that the premiums will depend on two factors, basically the delta factor, which is also very often describing the distance of the strike price and the current stock price, and the time aspect. Mm-hmm. So if I still want to have nice premiums, either the strike price needs to be super close to the current share price, or the expiration date needs to be far out. So there's always a balance between the two. If, for example, Unilever again 47 euros versus a strike price of 45 euros. If I can get a nice premium within 1 week, then I can do it. But I mean, sometimes I'll also take expiration dates that are a little bit further out. It's really depending how much safety margin do you want to have.
Cool. So you're basically picking stocks that you want to buy in your portfolio, which is good. But we spoke about Greeks earlier and how important they are to options trading. Do they play a part in your decision making for this particular strategy?
Actually not. So since I use the options here only as a tool, it is only about my normal dividend portfolio strategy. I have somehow my my price levels where I want to buy a stock. So and that's the primary decision for me. If I say again for Unilever that I get some premiums, I will take them. I will get paid for waiting, right? That's very nice, but I do not specifically check the Greeks in that perspective. It's purely based on business acumen and decision.
Okay. And money management must be quite important here because I know you're selling them and you're getting paid to wait, but then your money is tied up until that expiration date.
Yeah, exactly. That's true. So here again, it needs to be a part of the complete strategy, and that's why it's only a tool. It's not the main purpose in this strategy to sell options. It's just used as a tool, and it needs to fit in my complete dividend strategy.
Okay. I use that quite a bit. I use it on DeGuero for companies like Ahold while I'm waiting for them to come down to a price that I like. I use shorter term, maybe monthlies, and just collect premium while I wait. So my money's not tied up for too long of a period. And if something better comes up, I can switch to it. But maybe let's switch now to the wheel strategy a small bit and maybe outline the main differences between this and the option strategy for your dividend portfolio.
Yes. So the wheel strategy indeed is an independent part in my portfolio. It's really based on doing options trading to generate extra income. It's in my strategy, it's not connected to my dividend portfolio. I actually use rather growth stocks for this type of income, because there's a little bit of more juicy premiums and higher volatility versus a boring AT&T or Unilever actually as well. Unilever does not have the highest volatility. So here I rather take indeed companies like Neo, for example, is what I used in the past. I mean, I also have another development stage company where I burned my fingers. We can maybe talk about that later. But normally I use growth companies that still have a solid business model and a positive growth path.
So you're happy to hold those companies long term?
Exactly. And that's the point. Indeed, for a development stage, a drug or technology, I mean, of course, it's sometimes nice to have, but it is roulette, right? I mean, for when you engage with the wheel strategy with a company, and next week you hear like, okay, the drug did not pass a certain stage. I mean, that's the risk of the stock again, and has nothing to do with the options trading part here. So indeed, I focus on companies that I have clear track record. They grow, they have nice business models, and sometimes I see it a little bit, as a replacement of dividends if they don't pay dividends.
Yeah, I struggled with that a little bit in picking growth stocks because inherently, I know dividend stocks, I know how they work. I want to hold them long term, and I have chose stocks like Neo on this, but I don't really want to hold them long term. So I sacrificed a little bit of volatility and premium to stick to what I know, but I can certainly understand why you would choose growth stocks because you're getting compensated a little bit better for the risk you're taking on. Now, I would imagine that the Greeks play a little bit more of a role in your decision making in this strategy.
Yes, exactly. So if we maybe look back what the wheel strategy is, it's actually a combination of cash secure puts. So you sell puts where you have the cash at hand. And the goal is actually to not necessarily get assigned. So you want to continuously get paid to wait. It's actually a very funny topic to think about. And in German, we actually have a specific word for that. Let's see if you can repeat. Stillhaltergeschäfte.
Stillhaltergeschäfte.
Yes, exactly. Very good. But I hear your Bavarian accent. But yeah, so what it basically means is indeed like doing business by doing nothing or holding still. And that's what you did, what you do in the wheel strategy in the first step. So you sell a cash secured put, and you just wait, and actually you hope that you not necessarily get assigned, to just keep the premium and have no other obligation. And of course, you have two outcomes. The first one, as described before, you are not going to be assigned. You just got the premiums. You do the same all over again. But the second step is indeed that you get assigned. So the stock price will be below the strike price. So you need to buy, because somebody makes money with that on the other hand, right? And then what you do, you keep these stocks in your portfolio. So you do not sell them right away. You keep them and use them for the covered call. And here again, what you also described earlier, covered because you own the stocks and you sell a call on them. And that's the second step. And it's the same approach. You choose the strike price higher than the current stock price. You get premium. Two things that can happen: either the stock price increases a lot, you will need to sell your stocks because your option gets assigned, or the stock price stays below the strike price. You got the premium, you keep the premium. I mean, it will anyway never taken away from you, and you do the same all over again. So you sell a covered call, you wait and see what happens. And for this waiting, you get paid again.
Okay. So if you sell a put option, we'll just assume that this stock is €100, and you've sold a put option for €90. It drops to 80. You are forced now to buy that stock at €90. What price do you set to sell covered calls at that point? So the stock is at 80, your average price is 90. Do you set it at 90, or do you try go above?
Yeah, so normally you should never sell the covered call below your base price. And that's indeed normally the strike price for which you bought the stock. But then, of course, you also need to deduct the premiums that you got so far, because it's, of course, you got the stock for $90, but you were collecting some premiums, maybe $1, $2 before. So your adjusted buy price is actually rather $88, $89, $87, something like that. And if you want to play it properly, you will choose the strike price to be always above your adjusted cost basis. And so you collect the next premiums again, and reduce your strike price. Well, sorry, not your strike price, your adjusted base price, contract by contract.
Okay. And if the price tanks a little bit more, you're just happy to hold and wait for it to come up, and then start selling cover calls as it comes up in price a little bit.
Exactly. I mean, there can be some certain situations when the stock certainly tanks 50%, that you might need to think about selling a second cash secured put, because the strike price that you need to choose is so far away and you do not get any premiums. I mean, then you can indeed, I mean, it's like a chewing gum, that you pull, and it's gonna be a long story. So sometimes you need to put a little bit more money into that as collateral to get a good premiums. But that goes again to the point that you also mentioned before. I mean, you need to be fine with earning the company, right?
Yeah.
And if you did proper homework, yeah, of course, say never, never, but if you have a solid company, stock price tanking 50%, I mean, how often will that happen?
Yeah, but it can happen,
Exactly.
and we've seen it happen. And COVID is an example. It dropped quite fast, but they also rise back quite fast as well. I suppose I have a slightly different take on that strategy from you, in that I only choose companies that I'm happy to hold 200 shares in, and I will sell the first cash secured put. And if the price tanks by 50%, I will certainly be having another cash secured put, because I'm happy to own them at that price. And then I'll only start selling covered calls after I have 200 shares and start that way. So that's my only slight variation. But again, I'm choosing dividend companies. There's lower movement, there's lower volatility, and lower premiums. So it's for me, it suits my risk tolerance a little bit more, but I'm just not going to make as much money as someone who chooses other companies. So what other kind of companies? So I know you mentioned Neos. Is there any other companies that you are currently looking at the minute that you use?
Yeah, so I'm as well looking at Yandex, actually Russian, Google, so to say.
Yeah.
They're also listed in the New York Stock Exchange. Then, I mean, okay, I will disclose now my bad pick. I mean, I also get, into troubles with QuantumScape, which is indeed a development stage company working on solid state batteries. I mean, it sounded so exciting. Bill Gates is involved, Volkswagen is involved. I start my first cash secured put. 2 days later, short seller report. Pam. Yeah, say never, never, right?
Yeah. But that's a good learning.
Exactly.
Quite early on for you. And you've learned not to go into companies that are in development stage and maybe stick to companies that have a little bit more of a history behind them. And where do you, I suppose, how do you pick those companies? What resources do you use to find companies
That's
for this?
definitely a tricky topic. There are some stock screener where you can sort for implied volatilities, so you can indeed sort by the IV. But to be honest, if you scroll through the list, you get so many companies that I personally do not want to own. So it takes a little bit time to look through those lists of companies. Partly there's also Reddit community, so not Wall Street Bets, I have to say, but Theta Gang is a very nice Reddit community that talks about those kind of, doing nothing and getting paid strategies, so to say. So there are always, some inspiration which companies other people trade. But then indeed, I mean, I also just follow some growth stocks. I mean, NIO was definitely mentioned a couple of times before in our dividend day community.
Yeah.
And then, like others, or well, like me as well as dividend investors checking quarterly earnings, I always open the option chain tab to see like, okay, what's happening here? Is this something for my wheel strategy portfolio?
Cool. Yeah, I found it quite difficult to find decent screeners that you don't have to pay a large amount of money for. So I pretty much use what I want in my portfolio. And like that, if something drops suddenly, that will increase volatility, and it's always a good opportunity. So I keep an eye out for that. Finviz is another one that I use quite regularly as well. So maybe just to finish up, what are the pros and cons of this strategy, and would you recommend it to replace dividend income, or would you recommend to have it as a part of an overall portfolio?
Yeah, definitely the latter one. So for me, it's an addition to the dividend portfolio. It is not as passive as receiving dividends. I mean, there's quite an active element with it. You need to look for the company, select strike prices, see what makes sense. There's indeed a little bit more work related to that. But in my opinion, it's a great way to generate additional income especially with companies that do not pay dividends. So that's certainly what I enjoy. And from a performance perspective, I mean, you can always argue, why not buying NIO, for example, and just enjoy the rising stock price, right? The wheel strategy, how I see it, is good if the stock price goes sideways, because you just get paid for doing nothing, right? It's also good in situations where the stock price is going down slowly, because you get premiums on top of holding the stock. But indeed, there's the disadvantage if the stock is suddenly surging 60-70%, your covered call will cap those capital gains. You need to sell at a lower price. You miss out some earnings. But that's why, it's also for me actually a nice compromise for growth stocks, because I compensate a little bit the risk that a growth stock could certainly go sideways or slightly down. And if it surges, okay, then I did not get the biggest part of the cake, but I mean, still some, and I find it completely fair for the risk that I'm taking.
Yeah, and I agree. And what I'm struggling with lately is that I'm doing so well with this strategy that it's overtaking what I'm earning from my dividend income with a much smaller portfolio size. And part of my brain is like, why don't I just transfer all my money over and take this on? But again, it's just too much risk.
Yes.
And yeah, I've done trading kind of on Betfair before, and I know that you can get caught in the 40. It's easy, but you will inevitably hit a downturn. So I prefer to keep them separate. I have the Gyro I use exclusively for dividend stocks, and I use Interactive Brokers exclusively for option trading. And don't mix them. But it is certainly a nice income earner for me. I'm nearly doubling what I'm earning on dividends, so it's working out quite well. Okay, no, that was a nice conversation on options. I mean, it's a basic strategy, and just to recap, there's only a couple of different steps that it involves. Step one is to sell a cash secured put. Cash secured means you have enough money in your account to be able to buy that stock if and when you're assigned. Step two is if you get assigned, you then sell covered calls on that, and you just rinse and repeat. And it's as simple as that. I think the biggest I don't know, the biggest thing I would say is that only choose stocks that you want to own, because you're going to get landed with companies, and I've told you I've been landed with both Ride and Solo, and I'm stuck with them now. They're well below the price I paid. I've ended up selling Leaps, which is long distance, to get some high premiums to make some money back. So only definitely choose stocks you want to earn, and it's a nice strategy just to keep ticking over and earning some additional income.
Exactly. And what I can recommend, if you want to try option trading, start maybe with individual cash secured puts for companies that you would anyway buy for your dividend portfolio. Start with covered calls for companies that you would anyway want to sell. I think you did it also recently with AT&T, right?
Yeah.
So with the big news, with the Time Warner Discovery topic, you could always sell a covered call saying like, okay, good, I will sell AT&T in 2 months from now for a price. I'm not sure which one is currently reasonable to choose. But you can use it in a first step indeed as a tool for the dividend portfolio. And then when you understand the mechanics and all the Greeks and the parameters, I mean, we did not discuss all parameters indeed, which delta to choose, which expiration duration to choose. I mean, but there are plenty of videos available on YouTube. Maybe the only recommendation, do not take the ones that show on the thumbnail like how to make $500 per week, because they normally take also crazy stocks. And believe me, you don't want to do that.
Yeah. Oh, definitely stay away from Reddits. And look, you have all these different option trading techniques. You have iron condos, you have butterflies, and they all have a time and a place. But they might make you more money, but they do inherit more risk. So I would keep it simple. Stick to stocks that you own or that you want to own. Sell puts and sell covered calls, and you'll make nice additional income each and every month. Okay, cool. So this section, we will move on to the listener questions. Now, this is quite strange because you normally ask us the first question. So today I'm going to be asking you the first question, but it's from Dividend Wave. Okay.
Yeah, I'm fine with that.
And he has asked you, what are your top 3 favorite dividend companies at the moment?
Yeah. So first of all, definitely Fresenius. So the German hospital company. Of course, they do way more than that, but they just have a solid dividend track record. They are definitely over 25 years of increasing dividends. I think 15% CAGR, something around that. And I enjoyed buying the dip over the last quarters, because hospitals were certainly in the focus area with the complete COVID story. The second one is certainly Unilever. Was, I think, the first quarterly paying dividend stock that I owned. already since a couple of years. Yeah, just great to own them. It's also products which I use personally, so it's nice to get their dividends. And the third one is, to be honest, I'm not sure if I should choose Realty Income as kind of a monthly dividend paying REIT. I started to actually like WP Carey more and more.
Okay.
They also REIT, okay, quarterly payments, but that's I think not necessarily the main criteria to choose a company, right? But they have a broader industrial diversification with their properties, and also more in overseas. For us in Europe, of course, Americans say it overseas, but I mean for us in on our continent.
Yeah.
So that's also a nice company.
Good. Yeah, three pretty cool companies. The WP Carey is one that I've always looked at, and I've not got involved. They always seem to be a little bit expensive, but I have to really dig a little bit deeper into them. But they are certainly a solid dividend paying company. So no, three interesting picks. Okay, so Jonas Q92 has asked us a question. How do you know when it is time to buy a stock when it is only going up? I mean, stocks only go up, right?
Exactly, to the moon.
This is a difficult question because averaging up is something that is psychologically hard to do. And I know I struggle with that. I have a price point for a company. Walgreens is one that I struggled with as well because I'd like to add some more. My cost basis is really low. And even though they're at a fair value, I feel like they're at a fair value. I'm a little bit greedy and want them to drop a little bit lower. So it is difficult. The only thing I would say is that if you dollar cost average, if you have money aside and you want to buy a particular amount of this company, just dollar cost average in over a period of time and just forget about the price, especially if it's a long-term hold.
Yeah, and also another point to add here, certainly, if the rising stock price, is justifiable, or you can justify it with strong fundamentals that also rise, then you actually should, remove this little anchor out of your head saying like, oh, I need to buy a stock at $100, because that value, I mean, it's logical that a stock price goes up when the company is doing great.
Yeah, good point. Okay, the third question is from Cameron Deal, and he has asked us, knowing that time in the market beats timing the market, valuations seem high. Are you investing the same amount of money monthly compared to 2019, or maybe keeping a small amount of cash for a future correction?
So if I have to answer that, I certainly care about the valuation of the market, but I'm convinced that there are always some companies that are slightly cheaper. But certainly, if you see a lot of greediness, I hope that's the right word, in the market, then it's maybe good to have a little bit of extra buffer. I think we as younger investors, noticed it last year, right? I mean, if there's blood on the street, it's time to buy stocks, and that's how I do it. If really all the stocks, all the indices are going up, but I think still at this moment in time, you still have a lot of companies that are fairly valued, below fair value. So maybe you should just change the focus a little bit.
Yeah, I mean, this podcast is nearly a year old next week, and listening back to some of the early episodes, I was talking about expecting a crash, and that has just not happened in over a year. And this was after COVID. I still thought valuations were high around September, October, that we rose too fast after the pandemic, and we just keep going up and up and up. I'm convinced, don't listen to me, I'm convinced that there will be some sort of correction. I just don't know when. If I was not to continue with my strategy, I would have missed out on lots and lots of gains. So I have my own thoughts, but I still invest the same amount. It's actually slightly more than 2019. I still invest that every month and put it into the stock market, because if I could time the market, I'd be a very wealthy man, but I can't. So I just stick to monthly investing, praying for a correction, but if it doesn't, at least I'm sticking to my plan. Okay, we have a question from Welcome to the SciTech, I think it is. I don't know how to pronounce it. It's a Twitter handle. And he has asked us, is it better to pick individual dividend-paying companies such as Unilever, or is it better to buy dividend-paying ETFs such as ticker SCHD or ticker VYM?
Yeah, I think for that we need European DJI, right? I mean, he made a great video about dividend-paying ETFs, and I do not know specifically those tickers, but definitely pay attention which companies they choose. If it's only about high yielders, then you should definitely pay attention. Maybe it's not a good ETF to start with. If it's, let's say, the typical dividend aristocrat, okay, then you normally know what you get with this ETF. Then it could be a choice. Personally, I go for individual stocks, but I think I also see the point of buying decent dividend-paying ETFs if their base is solid.
I mean, my thoughts on this is, if you have to ask a question like that, I believe you're better off in ETFs, because you may not have the experience, or you may not want to research or put the time into individual companies. Being from Ireland, ETFs are a little bit harder to invest in, particularly the US ones. We can invest in unit trusts and so on. The taxation is a little bit of a bugbear for me as well, so there's also that element. But giving a level playing field and all things equal, if you don't enjoy researching individual companies, if you don't like reading reports or keeping up to date, probably an ETF is a much better option. Those are my thoughts. Okay, and the last question comes from Decline a Capitalist, who's quite a funny guy. And he has asked, what is your biggest annoyance of European DJI?
I will not answer that.
Phil is abstained from this question. He likes to come on the show every now and again, and he stated beforehand, do not ask me that question. Honestly, I don't have any big annoyances or any annoyances from European DJI. He's an incredible co-host. He's taught me a lot. He's helped me a lot, and his content is pretty much amazing. I don't want to give him a big head, so I hope he doesn't listen to this, but I just think he's underfollowed and a little bit underappreciated on Twitter. His YouTube is starting to grow, so I just recommend anyone listening to check him out and give him a like. Okay, cool. Thanks a million for the question, guys. They were all great. Decline a Capitalist tried to get us into trouble, but no, great question and quite funny. So the last section will be the stock pick of the week, and I will choose one this week, and it came on the back of AT&T. I know in our groups we have a little dividend day group with European investors. There was lots and lots of commotion about AT&T. Lots of people were selling. Lots of people were quite rightly worried and so on. And I identified one company in the group at the time as a potential replacement, and that is Orange. So they're a French telecommunications company. They have quite a nice yield. I think it's around 5-6% at the moment. Looking back at their history over the last 10 years, it looks quite choppy. So revenue is all over the place. Sales are all over the place. They are starting to settle down. Competition is high, but they're starting to invest in other areas and expand out from France. I know they're in Spain, they're in lots of places in Europe. They're also in America. The cash flow over the last 5 years has been quite strong. They're up around 2.2 billion at the moment. They're aiming for 4 billion by the end of 2023. The first quarter of this year they had really, really strong results, apart from in France. But everywhere else they had really strong results. Their EBITDA their net debt to EBITDA is about 2x, which is much, much better than AT&T. A little bit less debt than that, and you get compensated quite well with the 7% yield. So I definitely would check them out. I don't know if it's a long-term hold, really, but I would certainly be happy to hold them till maybe 3, 4, 5 years. I think there's a lot of room for capital appreciation in their stock price. I think they're undervalued by some 15, 16%. And that high dividend yield will replace AT&T's. And I believe they're paying, I forgot to check before I come on, but I believe they're paying a special dividend as well due to some tax benefits that they got back from the French government. So certainly one to check out if you sold AT&T or are looking for another risky telecommunications company in your portfolio.
Maybe a side question to the topic of today. Would you choose Orange as a stock for the wheel strategy?
I would, but the price is low, so the IV is low, so the implied volatility is low, and inherently then the premium is low. So premiums, I'd be looking at pretty small premiums for that. So I haven't included them in it for that reason, but I am looking probably to add them to my portfolio. I need to do a little bit more research and a little bit more in depth on them, but certainly from what I've seen over the last 5 years and where they're going in the next 3 to 4 years, I'm quite happy to hold them medium term. Okay, thanks a million for that today, Phil. That was great. That you helped us out. You filled in the void for European DJI, who's, as we said, off on holidays. It's been a pleasure to have you on and talk about this strategy. And you're always welcome on the show, you know that. So thanks you so much for coming on.
Yeah, thanks a lot. It was definitely great being part of this again. And let's see when EDGI goes on vacation again. I'm always here to jump in.
We might have a little vote on who we should have as co-host. You or European DJI. We'll see how it goes. But no, honestly, it's been fantastic to have you back on. As always, to our listeners, thank you so much for listening. Next week is our 1 year anniversary, and myself and European DJI are looking to do something a little bit different and hopefully a little bit more special. So stay tuned for that, and we'll see you all next week.